The trader you become. The lessons behind every trading rule. Most traders have rules. Some write them down. Some memorize them. Some promise themselves they'll follow them. Yet many traders eventually discover something frustrating. Knowing the rules doesn't always mean following them. Why? Perhaps because many traders see rules as restrictions. Professional traders often see them differently. Every trading rule exists for a reason. Not to make trading harder, not to remove freedom, not to limit opportunity, but to protect something that experience has already taught them is valuable. Every rule has a story. Every rule was created after a lesson. Some lessons cost money, some cost confidence, some cost months of frustration, some cost entire trading accounts. Professional traders don't create rules because they enjoy having restrictions. They create them because the market has already shown them what happens without them. Perhaps the biggest mistake isn't breaking a rule. Perhaps it's forgetting why the rule existed in the first place. Because once the reason is forgotten, the rule begins to feel optional. Maybe just this once. This situation is different. I don't think this rule applies today. And little by little, the lesson that created the rule begins to disappear until the market teaches it again. Professional traders understand something important. The market is an excellent teacher, but it charges tuition. Sometimes that tuition is small, sometimes it's expensive. The purpose of a trading rule is not to keep learning the same lesson. It's to remember the lesson that has already been paid for. Chapter 1. Rules protect more than money. Many traders believe trading rules exist to protect the account. Professional traders eventually discover they protect something much more valuable. The trader. A stop loss protects more than capital. It protects emotional decision-making. A trading window protects more than time. It protects focus. A position size protects more than risk. It protects the ability to stay calm. A high-quality setup protects more than probability. It protects clarity. A management system protects more than profits. It protects consistency. Every rule exists because at some point, the trader experienced what happened without it. The market became the teacher. The rule became the lesson. Perhaps that's why professional traders don't see rules as restrictions. They see them as reminders of lessons they've already paid for. Because every rule represents a mistake they don't need to repeat. Looking closely, something interesting begins to appear. Almost every rule is trying to protect something invisible. Patience, focus, confidence, clarity, energy, self-control, self-reliability. Money is only one part of it. Professional traders understand that protecting themselves often becomes more important than protecting today's profit. Because when the trader is protected, the process survives. When the process survives, consistency has a chance to develop. Chapter 2. The market teaches before the rule exists. Very few traders sit down one day and invent great trading rules. Most discover them, usually after making the same mistake over and over again. The market has a remarkable way of repeating the same lesson until it's understood. A trader moves the stop. The market teaches something. A trader overtrades. The market teaches something. A trader chases the end of a trend. The market teaches something. A trader keeps trading after losing focus. The market teaches something. At first, those experiences simply feel frustrating. The trader thinks, I need a better strategy. I need a better indicator. I need better entries. But over time, something begins to change. The trader starts noticing patterns, not patterns in the market, patterns in themselves. Perhaps every big loss followed the same behavior. Perhaps every blown account started with the same decision. Perhaps every frustrating day began with abandoning the same process. Eventually, the trader realizes something surprising. The market wasn't trying to punish them. It was trying to teach them. The lesson kept appearing because it hadn't yet become a rule. Professional traders eventually stop asking, "Why did this happen again?" and begin asking, "What lesson keeps repeating?" Because every repeated mistake is usually pointing toward a rule that hasn't been created yet. Or perhaps a rule that has been forgotten. The purpose of experience isn't simply to collect more trades. It's to transform repeated mistakes into repeatable principles. That's how professional trading rules are born. Not from theory, but from experience. Not from hope, but from evidence. Every rule becomes a promise that says, "I've already learned this lesson. I don't need to pay for it again." And perhaps that's why the strongest trading rules are often the hardest ones to ignore, because they're written with experience, not with opinions. Chapter 3: Every trader doesn't need every opportunity. One of the biggest changes many professional traders eventually make is surprisingly simple. They stop trying to trade everything. Early in a trader's journey, it's easy to believe that every movement in the market is an opportunity. Every pullback, every breakout, every reversal, every continuation, every candle feels like something that should be traded. Professional traders eventually discover something different. Not every opportunity is their opportunity, because different parts of a trend don't offer the same probability. Some parts are clear, some parts are complicated, some parts are directional, some parts are uncertain. The market doesn't move in a perfectly straight line. It expands, it pauses, it corrects. It becomes noisy, it becomes emotional. Many traders lose money not because they chose the wrong direction, but because they chose the wrong part of the move. Eventually, experience teaches them where they perform best. Some traders realize they consistently perform well when momentum is strong and direction is clear. Others realize they perform best after a confirmed breakout. Whatever the strategy may be, professional traders eventually stop asking, "What can I trade?" and begin asking, "What am I best at trading?" That question changes everything. Because once the trader knows where their edge exists, everything else quietly becomes easier to ignore. The market may offer hundreds of opportunities. The trader may only need one. Professional traders understand that consistency doesn't come from trading more opportunities. It comes from repeatedly trading the right opportunities. The rule wasn't created to limit freedom. The rule was created to protect clarity. Because clarity removes hesitation. And hesitation often leads to emotional decision-making. Chapter 4: Why Good Entries Matter. Many traders believe a good entry simply improves the reward-to-risk ratio. Professional traders eventually discover that a good entry does something much more important. It protects the trader's psychology. Entering at a good location often means the trade has room to develop naturally. Normal pullbacks still feel normal. The stop continues to make sense. There is less pressure to interfere. But a late entry creates a completely different experience. The same pullback suddenly feels uncomfortable. The stop feels too close. The loss feels too large. The trader begins questioning the plan. Perhaps the stop needs more room. Perhaps the trade deserves another chance. The market hasn't changed. The trader's location within the move has. Professional traders understand that where they enter often determines how difficult the trade becomes emotionally. A good location usually means a smaller amount of accepted risk. And accepted risk is important, because risk that hasn't truly been accepted often becomes negotiation later. Many traders don't move their stop because the stop was wrong. They move it because they never became comfortable with the amount they were risking in the first place. Professional traders know that accepting the initial risk before entering is one of the most important decisions in the entire trade. Because once the trade begins, that decision has already been made. The trader's job is no longer deciding how much to lose. The trader's job becomes executing the process. A good entry doesn't eliminate emotion. It simply gives the trader fewer reasons to negotiate with the original plan. Chapter 5. Why professional traders limit their trades. One of the hardest lessons many traders eventually learn is that more trades do not necessarily create more opportunities. Sometimes they simply create more exposure to fatigue, more exposure to impatience, more exposure to emotional decision-making. Many traders begin the day with a clear plan, one high-quality setup, one well-defined risk, one clear objective. But after that trade, something begins to change. The market is still moving. New candles continue to appear. The trader begins thinking, maybe there's another opportunity. I've only taken one trade. I still have time. Perhaps the original plan quietly disappears, not because the trader intended to abandon it, but because the mind begins searching for something else to do. Professional traders understand that after a good trade, one of the biggest dangers isn't the market. It's the feeling that they haven't done enough. Sometimes a trade lasts only 20 minutes, sometimes less. The trader made money, followed the process. Everything went according to plan. Yet another thought appears. That was too easy. I should probably keep trading. I haven't really worked today. Professional traders eventually discover something surprising. Activity and productivity are not the same thing. One excellent trade executed well may accomplish everything the day required. Taking another trade simply because the trader feels they should be doing more often leads away from the original process. Random entries begin to appear. Stops become less planned. Targets become less clear. Execution becomes reactive instead of intentional. Professional traders understand that limiting trades isn't about trading less. It's about protecting the quality of every decision they make, because every additional trade should still meet the same standard as the first one. If it doesn't, perhaps the process has already been completed, and perhaps the most professional decision is knowing that today's work is already finished. Chapter 6. Why professional traders respect their trading window. Many traders believe a trading window exists because the market changes. Professional traders eventually discover something different. Sometimes the market isn't what changes. The trader does. Early in the session, the mind is fresh. Focus is clear. Patience is easier. The process is easier to remember. But as the hours pass, something subtle begins to happen. Mental energy slowly decreases. Attention begins to drift. Decision fatigue quietly appears. The trader may not even notice it. Yet small changes begin to show. The stop is managed a little differently. The setup doesn't need to be quite as perfect. One extra trade doesn't seem like a big deal. The process slowly becomes more flexible. Many traders continue trading because they believe there are still opportunities. Professional traders understand that there probably are. The question isn't whether opportunities still exist. The question is whether they're still the same trader who started the morning. Because becoming tired doesn't always mean feeling sleepy. Sometimes it means becoming impatient. Sometimes it means becoming overstimulated. Sometimes it means forgetting the process they followed so well just a few hours earlier. Professional traders don't only manage market risk, they manage personal risk. They know their attention has limits, their patience has limits, their decision-making has limits. Respecting a trading window isn't about avoiding opportunity. It's about protecting the quality of the decisions still to come. Because more exposure doesn't always create more profit. Sometimes it simply creates more opportunities to make mistakes. And eventually, Many traders discover that protecting their best hours often becomes more profitable than trying to trade every hour. Chapter 7. Why professional traders never trade without a stop loss. Perhaps no trading rule feels more restrictive than using a stop loss. Many traders eventually convince themselves, this trade doesn't need one. I'll manage it manually. I'll get out if it goes against me. Professional traders often understand something different. The stop loss doesn't exist because every trade will lose. It exists because eventually one trade will, and no trader knows which one that will be. A stop loss protects much more than money. It protects the ability to continue trading tomorrow. It protects confidence. It protects emotional stability. It protects months of consistent work from being destroyed by one emotional decision. Many traders experience something painful. They spend weeks building an account. One good decision after another, one disciplined trade after another. Then, one moment arrives, one stop is removed. One loss is allowed to grow. Weeks of progress disappear. Professional traders understand something important. Large losses rarely happen because the market moved unexpectedly. They happen because risk was no longer controlled. The stop loss isn't predicting the future. It's accepting uncertainty. It quietly says, I don't know what the market will do, but I know exactly how much I'm willing to lose if I'm wrong. Professional traders understand that certainty doesn't exist. Protection does. And sometimes the smallest tool on the chart protects the largest part of the trader's future. Chapter 8. Why professional traders build trade management rules. Entering the trade isn't the end of the process. In many ways, it's the beginning. Because once the trade is active, the trader is faced with decisions. Should the stop stay where it is? Should it be moved? Should profits be taken? Should the trade be held longer? Many traders answer those questions emotionally. Professional traders try to answer them before the trade even begins. That's why they build management rules. Not because one method is perfect, but because consistency is more valuable than constantly making emotional decisions. A management system removes unnecessary negotiation. If the process says the stop stays where it is until a certain condition is met, the trader follows it. If the process says the stop trails behind structure, the trader follows it. If the process says the stop trails behind completed candles, the trader follows it. The specific method matters less than something else. Following it consistently. Professional traders understand that trade management has two jobs. The first is obvious. Protect the trade. Protect capital. Protect profits as the trend develops. But the second job is often overlooked. Protect the trader. A management system protects the trader from constantly asking, should I move my stop? Should I take profit now? What if it turns around? Because those questions are often driven by emotion rather than process. The purpose of management isn't to remove uncertainty. The market will always remain uncertain. The purpose is to reduce emotional decision-making while uncertainty exists. Professional traders know they will never eliminate fear. They don't need to. They simply need a process strong enough that fear doesn't become the one making the decisions. Because once management becomes emotional, the original plan quietly begins to disappear. And eventually, the trader is no longer managing the trade. The emotions are. Chapter 9. The rule behind every rule. Looking at each trading rule individually. They all seem different. One rule is about waiting. Another is about position size. Another is about stop losses. Another is about trade management. Another is about knowing when to stop trading. They appear unrelated, but perhaps they're all trying to protect the same thing. Not the account, the trader. A high-quality setup protects clarity. A good entry protects psychology. A reasonable position size protects emotional stability. A stop loss protects capital. A management system protects decision-making. A trading window protects focus. Limiting trades protects patience. Knowing when not to participate protects discipline. Looking closely, none of those rules exist because the market demands them. They exist because experience does. Professional traders don't create rules because they want more structure. They create rules because they've already experienced what happens without them. Eventually, they realize something surprising. Every rule is trying to protect the version of themselves they worked so hard to become. The calm trader, the patient trader, the disciplined trader. The trader who follows the process, because that version of themselves disappears surprisingly quickly once emotions begin making decisions. Every rule quietly says, protect this version of yourself. Not because the market deserves perfection, but because the trader deserves consistency. Promises made by the calm version of themselves to the emotional version of themselves. Final thoughts. Every trading rule exists for a reason. Every rule represents a lesson the market has already taught. Some lessons were inexpensive. Others were painfully expensive. Some cost confidence. Some cost months of progress. Some cost entire trading accounts. Every time a trader abandons one of those rules, they're usually not just breaking a rule. They're forgetting the lesson that created it. And the market has a remarkable way of teaching forgotten lessons again. Perhaps that's why experience alone doesn't create better traders. Experience only becomes valuable when it changes behavior. Otherwise, the same lessons simply repeat. Professional traders understand something important. The goal isn't to create more rules. The goal is to create rules worth trusting. Rules built from observation. Rules built from experience. Rules built from lessons already paid for. Then comes perhaps the hardest part. Remembering why they were written, especially when the market begins whispering, just this once. Maybe today is different. It'll probably come back. I don't need this rule today. If you've ever heard those thoughts, perhaps pause for a moment. Before changing the rule, ask yourself one simple question. Why did I create this rule? Not because the rule is perfect, but because the version of you who created it had already learned something the emotional version is beginning to forget. The calm trader wrote those rules. The patient trader tested them. The experienced trader paid for them. The emotional trader inside a live trade doesn't get to rewrite them, because 5 seconds of fear should never have more authority than hundreds of hours of preparation. Perhaps becoming a professional trader isn't about finding better rules. Perhaps it's about honoring the lessons that created them. Trade after trade, day after day. Because trading is not only a journey of learning the markets, it's also a journey of remembering the lessons we've already paid for. And perhaps that's one of the greatest reasons trading rules exist. If this video resonated with you, let me know in the comments. Which trading rule took you the longest to truly understand, and what lesson created it? If you know another trader who might benefit from this video, consider sharing it with them. And if you'd like more explorations of trading psychology, discipline, and the inner side of trading, consider subscribing. Because becoming a professional trader isn't only about learning new things. It's also about becoming someone who can remember and honor the wisdom they've already earned.